to go public. So, with that in mind, I will turn it over to our pre-recorded conversation with Mark Lenowitz. I hope you all enjoy. Please drop your questions into the Q&A, and we will be happy to get to as many of them as possible when we get to the end of the session. And any that we can't answer, we will certainly send his way and be in touch. So thank you, everyone, for tuning in as always, and we'll be back soon. We're very fortunate to be joined by Mark Alenowitz of Digital Offerings. Mark and his team have pulled off some of the most impressive Regulation A offerings over the past couple of years. I've been completely amazed by what they've been able to do. And I think if you want to learn about Regulation A, how to do it right, when it makes sense, all of the mechanics behind it, Mark is truly one of the pioneers of the industry. And there's a lot we can learn from him. So this is going to be a super, super interesting discussion, and I'm sure there's going to be plenty of follow-up that comes from it. But with that, I just want to turn it over and say, Mark, thanks for joining us.
I really appreciate you having me here today. It's so exciting to talk about what we've been doing and looking forward to what's going to happen here in the next couple of years as reggae becomes more mainstream.
I couldn't agree more. But before we go to where we're going, let's talk a little bit about where you came from, your background, which is pretty interesting, and what digital offerings is all about.
Well, I've been a banker now for going on 35 years. I actually looked back the other day. I got registered in 1990 is when I took my Series 7. So it's been quite a while. And we've always been focused on trying to find innovative and new ways in order to create capital formation for entrepreneurs. And back in 2013, 14, we started hearing about these words called Jobs Act. And it was interesting because we looked at it and we said, this is a great way to bring back the small cap IPO. And I started going to conferences and I would listen to the webinars and then I started participating in the panels. And what I realized very quickly was that most of the people that were looking at the industry really didn't come from Wall Street. They were more marketing firms or technologists that had some really creative ideas, but they didn't understand securities laws. And at first, everybody was talking Reg CF, and I would sit on the panel. I'd say, why would you ever do a Reg CF when you can't have an exit? If there's no ability to be able to sell your securities, it doesn't really make much sense. Now, this was then, and we've obviously seen the Reg CF evolve, and it's a great financing tool for early stage companies. But I used to always say, you drink your beer, you're going to eat your bread, and at some point you're going to want your money back, and you can't get it. So I started looking at Reg A Plus, and I realized that this was a way to basically have an exempt security that was free trading. And why can't it trade on a national securities exchange? So I went down to the New York Stock Exchange and I had a conversation. And at first they started laughing at me. They're like, Mark, we're the New York Stock Exchange. Obviously, we do not play in this field. And I said, no, let me hear you out because they thought it was, flying car nonsense and three-wheel cars. And I'm not naming any names, but back then there were a few of these companies trying to do these Reg A's. And I said, no, if you think about it, securities are either registered or exempt. And in an IPO, you use a Form S1 in order to file. Why can't we use a Form 1A in order to make it look, act, and feel like a traditional IPO? So I took them through it. And after a couple hours of working with them, they said, you know what, this could work. So we ended up doing the very first, which was a company called Myomo. It was the first Reg A onto a national securities exchange. It was onto the NYSE American. At the
Mm.
time, I think it was called the NYSE MKT. And it was the most work we've ever done on an IPO in our lives. We went up and down Wall Street. We talked to every institution. We talked to syndicate members. And the reality was no one was touching Reg A. They said, what is this? We're not going to get involved. It's hard to change people's mentality of doing deals the way they've always been done. So we barely got it across the finish line. Stock opened up down. And within a couple days, it was a triple and it traded millions of shares. And it showed that the power of the crowd was there and that people were going to embrace. And what really came from it and what got me most excited and why we embraced it is Myomo had therapeutic relief for people who had immobility. It was a robotic exoskeleton
Mm.
arm. And what ended up happening, this was an unknown company out of MIT. And why we were doing the deal, we basically marketed it in two ways. One for the security, but more importantly, one for the product. So, and I know a lot of panelists always say nowadays, well, Reg A is great that you can turn customers into shareholders and shareholders into customers. We were one of the first to say that, but we actually saw it happen because we started over the next year getting phone calls of people calling us up and saying, how can I get this product? Or
Mm.
somebody in my family found this product and they would have never known about it except for the Reg A. So it really gave us great comfort to know that we provided benefit to actual patients that were getting therapeutic relief from this. And that opened the stage to do Reg A's. And we've done several since then onto NASDAQ. And then we took a little pause because the market, I think, got a little frothy. Problem was that a lot of issuers look in the mirror, pick numbers that are unrealistic, and this is something we caution everybody, and valuations became outrageous. And it was very difficult to talk to an entrepreneur and tell them you're not worth 3.5 billion on 10 million in revenue. You're worth maybe on a good day 30 or 40 million. And they didn't want to hear it because the problem with the crowd is they would just come in and drink the Kool-Aid and buy. So we took a step back, and then digital offering came around, and we started to get back into the industry. And now we've been doing very iconic name brand companies, and it's been very exciting.
So, well, thank you for that background. And it's really interesting to see you guys kind of structuring these institutional grade rounds. You mentioned working with iconic names, Newsmax, the Times deal that you're working on right now. These are really large names for the industry to be raising in this way. Talk to me a little bit about those companies and what benefit they saw in taking this path.
So Newsmax was an ideal candidate for a crowd, and we call these crowd financed IPOs. We don't call them Reg A's. We don't say it's Reg A Tier 2 or anything like that. In our mind, it's an IPO. Looks, acts, feels, settles, opens for trading on the New York Stock Exchange or NASDAQ. It's an IPO. And what is great about using this methodology and Title IV of the Jobs Act, Reg A Plus, is there's no quiet period. So it enables you to communicate real time live. In a regular IPO, you have a quiet period, and it's difficult in this modern age when everybody's using their phone and they have instant gratification, instant delivery of news, and you're able to get this content delivered to you immediately. How do you go into a quiet period during an offering and not tell the world what you're doing? Reg A changes all that. So when we looked at Newsmax, it was a perfect candidate. You have millions and millions, tens of millions actually, of viewers that tune in and follow this network that are passionate about the brand. And Chris Ruddy, the CEO, has always been an innovator. And he recognized that this was a great opportunity to build brand loyalty by making the very people that are making the companies a success become shareholders. So we found that this was a crowd who came in. And what's great about the way we do our Reg A's is we limit the institutional investor to very small positions. What's
Hmm.
happened in today's market is it's gone from being what we call an issuer-driven deal to investor-driven. And what that means is that investors now dictate terms. And these have become what's called structured finance. So you have warrants or penny warrants or pre-funded warrants, unit offerings where the investors will really almost never lose because of reset provisions. But the retail investor gets hurt and the issuer gets less money at a lower valuation and the prices of their stocks go down. What we do is we limit those investors so we don't get flippers, as we like to call them, but we get long-term shareholders that believe that their capital will be used to grow the business. And that's exactly what happened with Newsmax. So when we went out and we were able to, we had over 9,000. Now we did this two ways. We first did a Reg D 506C, which is Title II of the Jobs Act. And then we did a 75 million, which is the cap on the IPO. And by the way, we within 4 days far exceeded the 75 million. We had to turn it off at 106 million. I realized what was going on, and we turned off the site because it was getting crazy. But we were able to have over 9,000 investors in the private placement and over 30,000 investors in the public offering. So what we saw was the power of that crowd. And these, like I said, it was an army of passionate people that believe in the brand, and it became self-fulfilling. The more viewers, more advertisers, more revenue. So it's a win-win for everybody. And the LA Times called us up. I had given a speech out in California, And one of the team members was at the speech and said, "Well, we've got to do this for the Times because it makes all the sense in the world too, because the Times is significantly bigger than Newsmax, iconic brand, and now is an opportunity to give back to the community that's been supporting this newspaper for, you know, decades, and now they have a chance to become an owner. So we're doing a private
Hmm.
placement and then the IPO."
Okay, so this is a good cautionary tale for founders because I've seen far too many of them go down this path. Let's talk about the negative things that can occur when you go through a micro IPO with some of these small investment banks that you might get approached by saying, "Hey, we can take you public." Um, I could just tell you from tracking all the ones who've gone through crowdfunding and then IPO'd via micro IPOs, many of them are down 80 to 99%. And it's because of some of the dynamics that you're hitting on. Can you talk to me about why those things occur, the things they should be aware of, and why this can be a better path?
Yeah, absolutely. So first, those banks that are doing those IPOs, they're my peers and colleagues and friends. They're not doing anything wrong. What's changed is the marketplace. So investment banks that do traditional IPOs, it's with something we call price discovery. It's done on all IPOs. So issuer will go out on a roadshow, present to the investors. The banker has a general idea of what the valuation should be, but ultimately, price discovery is determined by the street. And what ends up happening, because the market has shifted from issuer driven, where issuer gets the better terms, to investor driven, where the banker feels confident they can get them the money, in reality, it comes in at a much lower number, at a structure that's much um, more toxic to the company. But the company has now gone through 9 months, 6 months of work and is at the final number. And they thought they were getting 20 million and now they're getting 8 million. And they thought they were getting a $200 million valuation and now it's a $60 million valuation. They have nothing that they have to take it. But if you go back and you mentioned these crowd finance companies that are now doing these mini IPOs. What if you have to be the entrepreneur? If you look in and say what happened here, it's actually not the IPO that created the issue. It's the original crowd finance funding that created the issue. And most people don't recognize that. The money that was raised on platforms that are licensed to do those platforms are not investment bankers. They don't sit and have the hard conversation with the issuer and say, no, you're not worth this amount of money. You are worth this amount of money. Because what has to happen is these companies step up in valuation based on financial performance. So if you're doing a round at an evaluation where the stock has nowhere to go but down, and when you're using Reg A or Reg CF has a 12-month statutory hold, Reg A is free trading shares immediately. When these shares come public, those investors sell immediately. So if you did a round at 30 cents, 50 cents, and what happens with these companies is they're not really telling the investor about the valuation. They're just optically saying, hey, you're buying stock at 30 cents, and now the stock's at a $5 IPO, and you own stock at 30 cents. What are you going to do? You're crazy not to sell. So that's and it creates this self-fulfilling prophecy because the stock tends to go down, the structure kicks in, and the company didn't raise enough money to be public. And they only went public because they told their investors they were. And that I think the problem is you need to look and be confident that you're ready to go public. And being public is very expensive. And what most people don't realize, it's the beginning of the journey, not the end. The money you raise is to be put forth to grow the business. And if you come public with not enough capital, pros understand that. We know you're going to need to go back to the street, and we know the structure is not going to be what you want. So I would advise every CEO who's listening today, don't drink your own Kool-Aid. And I say this to them all the time. If somebody's offering you capital at a valuation that's reasonable and they're giving you more money than you want, take it. Because when you need that money, they won't be there. Always take money when you don't, because you'll have that war chest at a later date. If you're planning to go public, the street is going to know that you're going to need it and they will push on your stock.
I certainly appreciate that advice and thanks for sharing that. In terms of your deal sourcing strategy, it certainly sounds like now you're kind of making a name for yourself with some really major Reg A offerings. Um, what is your deal sourcing strategy? And frankly, what are you looking for to feel confident that it can be an effective and successful raise?
Well, right now, we currently have half a dozen to a dozen IPOs and offerings that we're doing. So our deal sourcing primarily comes from people who've seen the deals that we've done. They're involved in those kind of companies. We get them from lawyers and from other service providers. Uh, Most of the clients that we're working with are 50, 100, 200 million plus in revenue. They're much larger in nature. And because as a banker, it's always easier to do a big deal than to do a small. The company that's raising 3 to 5 million, you're spending all of your time. The company raising 100 million, you're spending a fraction of your time. And it's just economics at that point for our team. But there's opportunities, and we've created some new structures. So there are early stage companies, like one that we're incredibly proud of was a company called Monogram Orthopedics. They had done an original non-traded Reg A. We came in, we brought them public, raised them capital, did follow on offerings, created instruments for them once they were public that was enabled them to utilize again our crowd methodology for publicly traded companies. And then they had an exit where they have now been bought. So it was a perfect life cycle from start to finish. So we do look at earlier stage companies that are evolving. Like we're doing one right now. It will probably come out my guess is the second week in October. It's a $40 million raise. We already have over 44 million in demand. It's going on the NYSE American. It's early stage. It happens to be a space company that uses
Hmm.
hypersonic jets in order to put satellites into small orbit. And what's not unique with this particular company in terms of being where they are in their life cycle is they spent the money developing this. So they're pre-revenue
Hmm.
or small revenue, but now the money that we're raising them will enable them to really go into profitability and revenue in a significant manner. So you don't have to be a 50 to $100 million company, but we need to see that you'll get there within a relatively short period of time. And that's something I think every CEO needs to look at. Do you really want to be public? Do you want to be beholden to the street, have the responsibility of your Ks and Qs and regulatory filings? And do you really understand what that means? Do you have the time to be going out to doing conferences with analysts? And it's basically two full-time jobs. And every
Hmm.
CEO that does a Reg A knows they're spending most of their time raising money than they are running their business. But it really gets busy once you're publicly traded. So I think if I had to tell everyone that's listening today, we recommend, and we've done this now several times, do the non-traded Reg A first, raise the money, execute your business plan, put that money to work to grow yourself into a position that then you can come public and know that you need to demonstrate to the exchanges that you have the ability to remain public for 18 months without raising additional capital. So that's the key point, and I don't think people understand that. It's not a rule, but it's an unwritten discussion with the NYSE and with Nasdaq that you have to demonstrate compliance, that you've raised enough money, and we've seen those regulatory changes now occur where Nasdaq requires a minimum of 15 million in the IPO. If you're an Asian-based company, 25 million. NYSE is 10 million, and it's probably going to be raised up shortly as well.
So it's one thing to get all of your paperwork filed for Reg A and structure the deal and this and the other thing. It's another, to your point, to generate the demand and actually get capital into your deal. And I've seen deals where they spend 10, 15 million to raise 50, 60 million. In terms of generating demand for your offerings, how are you doing it? What are the strategies you're undertaking? And should people be setting aside really significant budgets to drive demand in their offering?
Yeah, so there's two ways of looking at this. So if you're doing a non-traded Reg A, you have the ability to have a closing, and when we do our non-tradeds, we close every couple of weeks. So the company's constantly getting the funds, and we tell the company to deploy 10 or 20% of the amount of money that they raise in order to raise additional capital. So we work with a lot of different marketing agencies that are highly effective. And what we always say to the issuer is that it's a 1 to 5, 1 to 9 return, which means that if you invest a dollar, you should be able to raise $9 for that. And that would be what we would consider a company that we would be interested in because that cost of capital is a lot less. You just said basically something where we saw almost a 50% cost of capital. That's a very expensive undertaking. And if it's a 4 or 5 times return, that's really the bare minimum that we would really look for. The problem if you're doing a Reg A IPO, the way we do them, is you can't touch the money till the very end. So you need to have a war chest going into it to drive that investor interest. And we utilize a lot of innovative techniques that most crowdfunding and Reg A platforms use, which is social media ads and digital marketing, webinars and newsletters and other visibility programs. What's been unique about our deals and why Newsmax was so successful is that we were able to go on air and talk to the audience. And I was doing 7, 8 times a day, even during the private placement, where we're talking about the offering because the law now
Mm.
allows you to do that. And we drive people to a landing page where then they can get all the informed information they need, all the risk factors, understanding the offering. And this is a big differentiator between a regular IPO and a crowd-financed IPO. When you go to that landing page, you can actually have a pre-recorded webinar. In a regular IPO, you can't, and you can't leave
Mm.
behind materials. You can only utilize the prospectus or the red herring, and you're limited in your communication under what's called Rule 134. With Reg A, to me, it makes all the sense. Why would you not want to be able to go and spend time, read the materials, listen to the webinar again? What did he just say? Rewind, listen. That's what we were able to do. So by with Newsmax, we would go on and we were getting $3 to $5 million a day in some
Wow.
circumstances when we would go on air because the investors would hear about the opportunity by watching it and being able then to go spend their time, investigate it, make informed decisions. So LA Times, same thing. So a lot of people are confused about, why are you going into the newspaper business? It's really dying. Well, LA Times is not just newspapers. It's this massive organization with media and studios and all these other great distribution points. So we'll be able to do that again, and we'll also be able to take out a full page ad in the physical newspaper and advertise the offering, which you could never do before Reg A came around.
Huh. Yeah, that's amazing. I love that you can do that. I mean, this becomes a really effective way to communicate with your customer on a multitude of different fronts. Um, let's dive in a little bit in terms of process. If a founder is thinking, hey, this is an interesting path, they fit your criteria, and you're talking about later stage companies with 50, 100 plus million in revenue, or have been a deep tech company that's invested very heavily in technology. In terms of time of process to get ready to have a successful funding round, what does that look like? And frankly, what's occurring during that time?
So the first thing I want to say is clear up a miscommunication or a misunderstanding that some of the media has stated around a Reg A IPO, or again, we call it a crowd financed IPO. So people keep calling it a mini IPO. Well, our mini IPOs are bigger than most regular IPOs on the street. So let's get rid of the word mini right away. This is a regular IPO, just using a different form of registration. That is important, that statement right there. When we do our offerings, they're done to an S1 standard. So the disclosure is identical as a regular IPO. And the regulators are looking at it like a regular IPO, and the exchanges are looking at it like a regular IPO. And I'm saying that because there's been some people in the media that say, oh, it's a light touch, the SEC doesn't look at it, and the exchanges don't look at it. I mean, that's just nonsense. You talk to any regulator at the exchange, they're going to say, what do you know, this is the New York Stock Exchange. Of course, we're looking at it. And that's important to answer your question because you need to prepare that you're doing a full public listing. And that requires audited financial statements. That requires a 200 to 300 page document that's being filed and reviewed by the SEC. That requires appropriate financial disclosures, controls and procedures, governance procedures, and understanding what it means. We require what's called a 10b5 opinion from the attorneys that are representing the issuer. So there's two attorneys at the table. That's something that's not normally done with these other platforms. There's an attorney that represents the underwriter and, in essence, the investors, and there's an attorney that represents the issuer. And so you should expect to do this to dedicate probably 6 months of regulatory filing from start to finish. This includes the audit. Once we get through the drafting phase, we usually see 2 or 3 turns with the SEC and then a comment period with NASDAQ or the NYSE that happens simultaneously with the listing. And then we start a marketing period that's usually 30 to 45 days. So I tell every issuer, start to finish 6 months, which goes back to about the marketing budget. You need to make sure you have enough capital to last you through the marketing side for at least 6 months. And then we conduct the offering. we do the crowd first. Once we have the crowd complete, we then open it up to Wall Street. We'll bring in 10 to 12 different firms, and then we have a closing, and the shares then begin trading immediately onto the exchange. So be prepared that when you're going through this process, some of the most comments that you're going to receive are going to be related to your financials, and they're going to be related to the disclosure around the business. And it's important. And this is the other thing is, again, this is a regular IPO. So there's going to be a lot of due diligence. There's site visits. There's talking to your vendors, talking to your service providers. And then there's also one more step, which is bringing in a board of independent directors and audit committee chairman that understands what it means to be a public company and what it means to do that financial reporting.
I'm glad you said all of that because I think what I want to get at here is like this is not a light undertaking. This is not to be taken lightly. And this is not being like, oh, I'm doing another Reg CF, right? A quick 5 million. This is easy. This is a very intensive process and it's something you're signing up for. It doesn't end at the IPO either, right? You need to continue to provide your semi-annual and annual reporting. So this doesn't go away.
No, it
Um,
just starts it. And
it
that's
just starts.
And if your stock, you don't raise enough money and your stock goes down, now you have the pressure of keeping those regulatory filings. And that's what we've seen. There are a few companies that came out who should have never come public, that were Reg CF, Regs, I guess they were Reg CF that became Reg A's that did, quote, direct listings or these mini IPOs came out when they shouldn't have. And, within 6 months, they were basically delisted. And NASDAQ has changed the rules that you can no longer do multiple reverse splits in a year. You have to have a certain amount of equity and share price in order to maintain your listings. And the exchanges are becoming much more involved in evaluating the fundamentals of the business. Where it used to be disclosure, it's now they're actually looking at it. And
Mm.
one more thing that to point out, and this is something that I don't think a lot of people realize, is that in order to do business both on NASDAQ and New York, you have to be a member. It's a limited membership. NASDAQ put the rule back in last May. Our firm, Digital Offering, we were granted the first license or first membership to be able to do this. And then New York Stock Exchange just put that same rule into effect. It came in on September 1st.
Mm.
So if you're talking to banks, and you're talking to people that are having these discussions with you, ask the question, are you able to actually do business with the exchanges? Because in the past, you just needed to be a certain type of broker dealer and you could do the business. Now you actually have to be a member of those exchanges. And to be a member, you need to have certain licenses with FINRA and certain capabilities. And that's all changed here and officially changed with the NYSE on September 1st.
Well, I appreciate all of this guidance. Cautionary tale is be careful, right? And this could be really, really powerful for the right company at the right time and place who can make the right investment in the offering. And I really appreciate you, Mark, for sourcing those deals, working with those types of clients, and making sure you make them kind of front and center in our industry. But this is not for everyone. And I think that's something that I really want to highlight is this doesn't make sense for everybody. Reg CF is great as an early issuer. Price yourself well and continue to raise capital along the way. This is when you get later stage. That's when it starts to really make sense. And then you could work with a great firm like Digital Offerings that has both the crowd capabilities plus the institutional capabilities and knows how to work with these big exchanges and get you where you need to be. So a lot you can learn from talking with Mark. Thank you so much for your time today here, Mark. This has been really, really educational. And for those who want to reach out, how can they access you?
You can go to digitaloffering.com. There we have a I guess it's a contact page there, or you can email me directly at Elenowitz, Elenowitz at digitaloffering.com, or you can just email us at deals at digitaloffering.com. And we respond very quickly. A lot of people get upset because we're the land of no, and we're only saying no because it's not no now, it's not no forever. It might be just no now. And what we do is we work very well with a lot of other firms. We're going to be happy to introduce you to other firms that can help you at that earlier stage if that's where you are. And if you're thinking about going public, and it might be a year from now, or 2 years from now, we're happy to give you the advice because we like to see you grow to a point that we can come in. It's really important for this industry as a whole, whether you're at an early stage company or a late stage, if you do it right, and we're trying to make Reg A the future of all small cap underwritings, because it makes all the sense in the world for you as an entrepreneur to be able to raise money from the very people that support you. And unfortunately, we've seen some failures that are giving the industry a black eye. And what we're just trying to change, and we are changing it. And Newsmax was the catalyst to kind of change it for the big companies to come in. But as a whole, it's not this structure. It's not the form of registration. It's bad companies, whether you're doing an S1 or a Reg A, it doesn't matter. If you're not ready to be public, you're not ready to be public. But if you are, why would you ever do an S1 when you can do a crowd financed IPO?
Hey everyone, I hope you enjoyed that conversation with Mark Lenowitz. As I mentioned, someone who's really, really impressive in our market and is doing some phenomenal deals, including the Newsmax deal, including now working on the LA Times deal, some other really large names coming down his pipeline, I know. So great, great organization. Certainly, if you're kind of a later stage, larger business that's thinking about, doing an IPO or direct listing, he's certainly someone that you should consider meeting and learning more from. And I'll be happy. I know we've gotten a handful of questions in here. Scott and I will chat about a couple of these questions here for the next 10-15 minutes. And then we'll also pass off any additional questions that are out there. Scott, good to see you.
You too, buddy.
So let's hit on a couple things. There's a few questions that have been dropped into the chat that I want to get to. The first one is, what are your views on SPAC versus IPO? Do you think SPAC is a good alternative to IPO? And Scott, I actually think is a great person to discuss this. So I'll let him provide some thoughts, and I'll provide some thoughts as well.
Yeah. Uh, I don't know, Chris, you tell me, SPAC, do you feel like maybe distant cousin to the IPO, mini IPO? I don't want to say it's between Reg A plus and IPO because it's certainly not, but there's a lot of like kind of it's not a normal IPO in the traditional sense. It's like a search fund kind of, but it's already the search is complete. SPAC got famous, better and worse from Chamath a few years ago. I feel like okay talking about this, knowing that I got bloodbath on one of his deals, Open Door, and then have since made up all of the money I lost, plus probably 50%. I'm still in, and I think that Open Door is a real company with real management. They replaced the CEO and put a new people in. The board did what they were supposed to do. So I think SPACs, before they became famous, were a real instrument. They just were not utilized frequently. I think that they got a bad rap. He's doing it again. I'm not even going to touch that with a 10-foot pole. I think it's a good product when done well. And I think there's no reason that you can't take a company and wrap it around, basically new leadership. I mean, it's like the PE model, but public, I think. So I don't have a problem with SPACs. I just think that there probably should be an extra layer of education for the retail investor before they get in it. And this will never happen, but there should probably be an extra layer of governance put in between the company that's creating the special purpose and the entity that they're basically, blank check purchasing. There should be something there that isn't there, because it shouldn't be simple to just be like, I just launched 5 specs. Like that probably shouldn't be how it
Yeah.
works. I don't know. What are your
No,
I don't think it's
I
fair.
think the market was well over flooded with SPAC organizations. There was not enough good deals to match the number of SPACs that existed. I think of SPACs a little bit like, I don't know where you all live, but down here in the Southeast, Mark Spain Realty is a huge group. And they do this thing where they'll buy your house for you. And basically, they give you an at the market price they're willing to pay. And then they go and sell it, 2, 3 months down the road, right? They might fix it up a little bit, whatever. And I kind of think of SPACs as the same way, where it's like you don't actually want to go through the work of doing a roadshow and IPOing and going through all the things that come with doing an IPO, which can be very costly, very time consuming, and exhausting, right? Not necessarily a process everyone wants to go through. And a SPAC is kind of like, we'll do it all for you. And all you have to do is agree to this check. You might not get the best price, it might not be the best deal, but it's all kind of done for you up front. So that's kind of almost how I look at the SPAC is I just don't want to deal with going public, but I
Yeah.
do want to go public. And again, I think there's just far too many where there wasn't enough quality deals to fit into that. The problem with IPOs, on the other hand, is that the investment bank is ultimately setting the price. They have all these different incentives structured into an IPO, right? Like they need to make their investors money. So they are not incentivized to really boost your price too high. Yes, they want you to be pleased, but they also want to make sure they take care of all the investors coming in. So they want to do future IPOs with them. So then you see these, first day 50, 100% pops because there's so much retail demand to be in these things. And one could argue, shoot, if those guys had done direct listings, they would have raised far more capital than they did through the IPO. The problem is there's not that many companies that have that much demand, and thus the IPO can work. What I really like about what Mark has done with the Reg A direct listing is that, again, it's kind of you're setting the price and determining what you think your company is worth rather than an investment bank doing that and then allowing that retail demand to come in directly. And so, in some ways, it is kind of like a direct listing and you're controlling more of the process. So, that's what I really like about the Reg A direct listing. I actually think it's a really unique, interesting path. If you don't need hundreds of millions, you need 75 million to get started. I think it's a great path. I really do.
Yeah, there's another question that popped up that I'll let you answer, Chris, on the direct listing is the same as the SPAC. Short answer is no. Chris can talk about it a little bit more.
Yeah.
I just want to put a cap on the Mark conversation from your vantage. When I talked to him in a different interview that we aired on King's Crowd podcast, which people should be listening to if they're not, because we get little clips like all these people you saw this week on the show. He talked about Newsmax as an example, but there were several deals that he had done where they raised well more than the average IPO amount raised for a company. And I think you kind of hit the nail on the head. And I coined this phrase when I like blacked out in one of our panels this week, where I was like, up until probably about a year ago, you could go back to the entire history of the stock exchange, and all capital allocation was supply driven. And I think that's where the IBs are. It's like we need to make money. We need to pick companies that we think we can push and sell. And you're the investor. You get that. You get what we give you. We are now in the era, and it will never change back, in my opinion, like short of like some sort of fraud. We are in the era of demand-driven capital allocation. Any person, any investor can say, I want to invest in a sports team. I want to invest in a creator. I want to invest in med tech. I want Series A, Series B, pre-IPO, post-IPO, SPAC. All you have to do is get a group of people who want to invest, raise your hand and say, I want to invest in it. And people like Chris and King's Crowd Advisory and others can reach out to these companies and literally help them list direct. And it's like the same thing that from the investor side to the company issuer side is you're now seeing it go from private to semi-private to a little more semi-private to semi-public to full public. And it's something that has never happened in the history of finance in the US, to my knowledge, a little bit in Europe, but in the US, it's a first. So we are we're talking about a brand new era of finance. It's incredible.
No, I totally agree. Another question that's here is, aside from an IPO or direct listing, are there any other exchanges or ways you've seen for equity crowdfunding companies to provide liquidity even on a limited basis to investors? Any thoughts there? I'm happy to share some, but
I mean, the only thing I can think of is that there's just a lot of different exchanges. There's obviously secondary markets. You could go into different secondaries. There's tokenization as a different thing. Don't need to go into that so much. There's a lot of people who like the Toronto Exchange. Like, again, it's kind of answering, but like I don't view that as like a traditional IPO.
yeah,
Not trying to
so
denounce them.
the best way that I see right now is to utilize Start Engine's secondary. So I am a major proponent of building secondary liquidity into the value prop of your business, whereas so many founders still think it's bad to provide secondary liquidity, even though they're doing these massive tender offers and all these things. There's a lot of value to saying to investors, hey, when you invest in my company, I'm going to find a path to get you liquidity along the journey. Start Engine has built a transfer agent and an ATS. They can manage your entire cap table, regardless of where you've raised, whether it's Republic or WeFunder. You could still get all of your investors onto the Start Engine transfer agent service, which is very affordable compared to other transfer agent services. By the way, not being paid for any of this. I'm just telling you this as a founder who wants to do this. And then they've built an ATS. Now, they're not chatting from the rooftops. They've actually, I would argue, been pretty quiet about it all. But they basically have a posting board where you can post, hey, I'm willing to sell my shares
Call
for X in this company. Yeah. And then if someone wants to buy it at that price, they can. There's obviously a lot of inefficiencies and things about it that aren't great, and that like it's not a great experience from an investor standpoint. But Jeff, knowing what your company is, you guys have a lot of investors and a lot of interest in your business. I would argue just amongst your own investor community, you're going to probably get more people who want to buy back in, and then other people who are looking to get out because they're just trying to move on to the next thing, and probably can create some liquidity within your own investor community. And I will tell you, we have about 4,500 investors in King's Crowd, and my plan is to onboard all of them to Start Engine over the next 6 months, and then to be able to offer those opportunities when we're not doing a primary round. Say, hey, have at it on the Start Engine secondary. That's my goal. I hope we see more and more tools like that come about and get better, and there's just more volume of investors in it to create more liquidity. But I think that's the best step and thing we have in the market right now.
I couldn't agree more. I think I understand that the NAV issue of like not wanting to see your shares trading, but like generally speaking, I think it's insane that we don't have everyone on secondaries. Like there's just different phases of investors. Some want to be in early for the long haul, long risk. Some want to just get out and get in, post A, post B. All these tools are coming because there's just so much movement in the market right now, and half of them will probably be owned by King's Crowd at some point.
And one very strong uh, thing that I will say is if you were a Reg CF issuer who has done Reg CFs in the past, and then you're thinking about kind of your future state and where you want to go from here, and you're thinking about liquidity, and you get approached by some of these micro investment banks that want to do a micro IPO for you, right? They want to do a really small IPO because your valuation is going to be really low. Um, be exceedingly, exceedingly careful. In most cases, I would argue you're probably too early. And if they're selling you something that sounds too good to be true, it probably is. I track every Reg CF offering that has done one of these kind of micro IPOs. And by micro, I mean now the rule is 15 million. If you're going on NASDAQ, you have to raise at least 15 million in your IPO. But a lot of these guys are raising $3 to $5 million. They're IPOing at valuations that were just not supported by the market. And then there's all these short sellers and all these terrible things, dynamics in the public markets that have been happening and just completely destroying the value of all of these companies, and the equity value of all these companies. Yep. So all I would say is it makes sense to go public when you've hit a certain aggregate size as a business, right? And at that really micro stage, it just doesn't make sense. And you're going to hurt your business long term doing that. The more you can continue to leverage Reg CF and step into a Reg A, the better. Don't rush to the public markets. You're going to be doing yourself a big disservice.
Yeah, totally agree. Chris, I'm going to pose you with a question since we're almost on our way out. Given the Mark conversation, I feel like what Digital Offering, and there's others out there, but them, because we've spoken to Mark, are really doing is they're sort of paving the way to make this normal. That like, yes, direct listing may be the end game, but not everyone is meant to be a public company. In fact, less than 15% of companies across the globe that do 100 million in revenue are public. Most are private and they'll stay private. But there are opportunities to bring in new investors. There's a handful of people, I think Mark talked about it, I know you've talked about it, who are basically aiming to go back and buy their original shareholders out and replace them with new things. I got to imagine that this is a perfect opportunity for Reg A plus. It's like CF to start, and then you get enough demand. It's like now we're in charge. We're making 5, 7, 10, $20 million top line, 2 million EBITDA. It's time for us to raise 5 or 6 million, buy out people, refresh the cap table. Like I just think that's a thing that's coming. How do you feel about that? And like where just directionally, where all these regulations are allowing us to go. Like you're the person who's running at King's Crowd Advisory, CrowdCheck, et cetera. So you see firsthand what's possible. Where do you think the markets are going to end up going from an issuer standpoint?
No, I mean, I certainly agree with you in that. I just think the idea of being a private company but having publicly accessible liquidity is going to become a thing where the idea of private versus public almost won't mean very much.
Yeah,
and at some point, the only reason you'd really go public is when you need to raise hundreds of millions or billions of dollars, right, to really take some to the next level. But the odds that you'll need to go, like, either the public regulations are going to pull back and become far simpler to attract people to go public earlier, because right now less and less companies are wanting to do that, or we're just going to see even more expansion of our industry where companies are just going to stay private and provide that liquidity directly through secondary platforms that are built in the private markets, because the process and the aspects of being public are not enjoyable. It used to be, well, now you could access this new pool of capital you didn't have access to before. If you can access in the private markets, why are you going public? And we've already seen that. I mean, there's half the number of companies that were public 20 years ago are public today. Less and less companies are deciding that's a path they want to go down. Um, so anyway, there one more question that hopped into the chat here. Can we sell any of our equity invested on some other platforms like WeFunder, et cetera, on Start Engine? Good question. So please reach out to Start Engine and ask them that question directly. My understanding is that actually there's a couple data points they would need to be able to verify before you could do that. But I believe the answer is technically yes, based on my understanding what they've told me in the past. But you should speak with them directly to see if your situation would allow for that. And then Scott, I'll throw this question over to you. Do you think that in the near future, all equities will be tokenized?
Technically, probably yes. I think it won't be all equities. I think that's extreme. I think all equities that are in a volume that will be traded will be. And I just want to be clear, $52 trillion worth of assets, that's some insane number like that, are already tokenized. Most of that is coming from the asset owners. They're contributing assets to the tokenization. They're not investing in them. They're just saying you can. That is because the utility of blockchain for trading purposes, for stock X, or sorry, X stock, whatever they're calling it at Kraken, for Robinhood, who's wanting to offer 24/7, right now it's 24/5, I think, trading, they're tokenized for that purpose. It's just a technical utility. It's not special. Ideally, it does make it to where you could use crypto and not, whatever. Like that's all deep stuff. I think anything that has demand for trading will be tokenized simply as a matter of like that's the updated rail system the finance industry operates on. As far as like, should you tokenize your house and your car? No, probably the short answer.
And I mean,
Not yet.
I think of tokenization really it's just what you're saying is we have established the equity in our company as a security that is tradable. I mean, really
Yep.
that's what it is, right? And sometimes the issue that I can take with tokenized offerings, I feel like people are just trying to get around rules or think that they don't have to follow
Yeah.
regulation when they're saying that word. The reality is I think all of these tokenized offerings are going to be considered securities and are going to be regulated. It's really just a way of creating a more open bordered secondary
I was just
platform
gonna
is what it
say
really
that
is.
you just the word before that was it. It open border. Like all
Yeah,
this stuff is still what Reg S. You're still going through King Squad Advisory to get the secondary security validation and all this kind of stuff. The tokenization part is just to make it really easy for the entire economy globally to participate in assets. That's all it is. It's otherwise it's marketing, in my opinion.
100%. All right. Well, as we're running up here on time, I wanted to announce, I know we have a winner. Let me look for their email here. I have it from, where is it? Let's see. Sorry, I'm looking for our one. Oh, I think I see it. Scott Kelly.
Yep.
Congrats to you. You've won the 3-month Edge membership. So we have your email and information. We'll send that over to you after this call today. But thank you so much to everyone for listening in today. Really appreciate it. For those who have added some questions that we weren't sure we could get to, we'll be sure to send those over to Mark Lenowitz. And we look forward to seeing you on our next session. And Scott, as always, thanks for hanging out. This was awesome.
You too, buddy. Thank you so much for